It's a surreal turn of events for an economy built on fiscal discipline. In December 2025, Berlin announced plans to borrow $512 billion on the markets in 2026, the largest debt sale in Germany's history. To put that in perspective, that sum even exceeds the roughly $500 billion borrowed during the 2020-21 COVID crisis. Until recently, Germany prided itself on balanced budgets and a strict debt brake cap, 0.35% of GDP. So how did the most fiscally conservative major economy swing into full-on spending mode? What will this vast sum be used for? And what could it mean for Germany, the EU, and global markets? For decades, Germany's leaders championed the Schwarze Null, a balanced budget with no new borrowing. Now that old doctrine is being overturned. Why so much? Officials stress this isn't money for day-to-day spending, but a once-off investment surge. The funds are earmarked for rebuilding decades of neglect, repairing crumbling highways and railways, upgrading schools and hospitals, expanding broadband and renewable energy grids, and strengthening the military. The spending splurge is aimed at fixing Germany's crumbling infrastructure and modernizing its armed forces, report Bloomberg journalists. In fact, Berlin has already created a $500 billion investment fund to finance extra infrastructure and climate projects over the next 12 years. Under the new plan, roughly $58 billion of the 2026 budget itself will go to direct public investment, and total government spending will top $524 billion. In addition, Berlin plans a $300 billion federal share of that 12-year fund, with states and climate programs adding another $200 billion. Alongside infrastructure, defense is getting a historic boost. For the first time, Germany will allow military outlays above 1% of GDP with no upper limit. This reflects a dramatic shift in policy. The 2025 budget raises defense spending sharply and even increases aid to Ukraine, an extra $3 billion, bringing total support to $11.5 billion. In short, this borrowing is targeted money, rebuilding roads and bridges, pouring concrete for schools, wiring cities for 5G, and pumping up the Bundeswehr and defense industry. Shattering the black zero. To appreciate the magnitude, consider Germany's fiscal history. The country's debt brake, enshrined in the Constitution since 2009, limited the federal deficit to just 0.35% of potential GDP. Combined with a culture still haunted by Weimar hyperinflation, this produced near-zero deficits and a falling debt-to-GDP ratio, around 60%, one of the lowest in Europe, in the 2010s. Balanced budgets became a point of national pride. All that changed in 2024 to 25. A new grand coalition agreed to suspend parts of the debt brake, creating that $500 billion fund and lifting strict borrowing limits. In March 2025, Parliament passed a landmark spending bill enabling hundreds of billions more for defense and infrastructure. Even conservative leader Friedrich Merz, once a champion of fiscal austerity, backed the overhaul. The result is unprecedented. Berlin is legally allowed to borrow massively again. One expert noted wryly that the debt brake had acted like an investment brake for years, and now it's off the tracks. In effect, Germany's long-held budget dogmas have been ditched to confront new crises. The planned $512 billion is mostly gross issuance, including the refinancing of old debt, but it still represents a major fiscal injection. Roughly $180 billion of it is net new borrowing. Think of it as rolling over billions in maturing bonds while adding a large infusion of fresh cash into the economy. The government insists this is investment, not a blank check. Besides roads and rail, the funds will also upgrade digital networks, build electric vehicle infrastructure, and expand renewable energy. A portion will support social housing to ease Germany's urban shortage. Moreover, about $16 to $19 billion of the 2026 debt will be sold as eco-friendly green bonds to fund climate transition projects, part of a larger effort including a separate $100 billion climate fund. This borrowing also finances national security. Apart from new fighter jets and ships, plans include boosting cyber defense and intelligence. Having witnessed Russia's invasion of Ukraine up close, German leaders now talk openly of spending whatever it takes to modernize the Bundeswehr. The 2026 budget lifts many caps. For example, state governments may now borrow up to 0.35% of GDP annually, and defense cuts have been reversed. All told, public investment is set to rise by 10% in 2026 over 2025, reaching about $126.7 billion when special funds are included. The contrast is stark. As one analyst puts it, unlike the COVID-era debt, this is a structural shift to long-term investment in national capabilities. And Germany's finance agency is even tapping longer maturities for the first time. A 20-year bond will be issued in 2026 due to strong demand. The overall breakdown for 2026 is 318B via regular bond auctions and 176B via short-term bills, plus the green tranche, all on top of existing rollover needs. The plan is a bold bet. On one hand, if Germany's economy can rebound, the payoff could be huge. Economists note Germany still runs a large trade surplus, about 6% of GDP, and has idle labor in construction and green tech. The boost in demand may help hire back skilled workers and spur innovation, for example in AI and quantum tech via defense R&D. Improved infrastructure would raise productivity and competitiveness across Europe's largest economy. As RBC Wealth Management observes, the fiscal stimulus could push Eurozone growth higher in 2026. After all, fiscal loosening is roughly like a tax cut, and Germany's multiplier on spending is positive when there's slack in the economy. Yet the downsides loom large. By one estimate, this borrowing will drive Germany's debt-to-GDP ratio up from the 63% today to around 73–81% over the next decade. Even in the optimistic scenario, with faster growth, ratios approach the high seen after 2010. Germany would still be below Italy or the US in debt-to-GDP, but the change is dramatic by domestic standards, and servicing so much debt will cost more. Analysts warn Germany will likely have to offer higher yields to sell this volume. In other words, bond yields may rise so investors bite. Indeed, as the supply floods markets, world bond traders are watching. A recent report by RBC notes that heavier bond supply will push yields higher in Europe. In fact, just the announcement itself caused German 10-year yields to tick up, surprising some experts. The ECB has already cut rates to boost growth, but officials worry that a surge in sovereign issuance could offset those efforts. If interest costs climb too much, it eats into national budgets, a classic risk of huge debt. There is also political risk. Higher yields could raise borrowing costs across the Eurozone, tight on indebted neighbors who saw Germany as a stable backstop. Inflation is another worry. Critics fear this fiscal blast could overheat the economy and reignite price pressures. The government retorts that much of the spending is on imports, military kit, specialized tech, and that Germany's export strength provides a buffer. So far, German inflation has eased from its 2022 highs, giving some policymakers confidence. But the balance is delicate. If global energy or commodity shocks return, big deficits would limit Germany's options. Germany's move does not happen in a vacuum. As Europe's powerhouse, its fiscal stance reverberates across the continent. In the short run, German risk premium is low. AAA rating persists. So many investors see the new bonds as safe assets. But an avalanche of German supply could nudge yields up in other core countries. The Bund effect often lifts French and even Italian yields. Simultaneously, a more buoyant German economy could help trade partners. S&P Global and other forecasters expect a positive spillover. German-led growth might lift regional demand, especially in Central and Eastern Europe. Monetary policy will be tested. The ECB must balance higher bond yields with its inflation mandate. If Germany truly maintains 2% inflation, the central bank may still cut or hold rates. But any tendency of rates to rise Europe-wide could prompt the ECB to reconsider easing. On the currency side, a fiscal stimulus could strengthen the euro, which helps importers but hurts exporters. Hard to predict, but analysts around the world are debating it as one of 2026's key global stories. A new fiscal philosophy? Ultimately, Germany's strategy raises big questions. Is the era of austerity over? Will other once frugal nations follow suit? In Italy and France, deficits remain high, but those governments have struggled to reform. Germany's surprise shift suggests one path: preemptive investment to fend off stagnation. Yet history is cautious. The German public is wary of debt, and some conservative voters have grumbled about the end of fiscal discipline. Only time will tell if this was prudent or reckless. Can Germany grow fast enough to make the borrowing pay off? Will the guns and butter trade-off, economists' term, upset the balance between security and welfare? One unsettling possibility: if growth disappoints and deficits swell, the very stability of the Eurozone could be tested. On the other hand, if infrastructure and innovation surge, Germany could emerge stronger and even lift the whole region. As one veteran commentator put it, Germany's debt level would still remain well below other G7 countries, suggesting there is room for maneuver. Yet public debate is heating up. Some see the move as overdue investment. Others see it as the start of a slippery slope. What do you think? Germany's 2026 borrowing blitz is a story with no clear end yet. It is a bold gamble at a pivotal moment, a sudden 180-degree turn for a nation known for caution. Whatever unfolds next, this episode will be scrutinized as a test of economic strategy. What happens when frugality collides with necessity? Will this debt-funded push kickstart Germany and Europe, or is it sowing the seeds of future trouble? Only the coming years will tell. For now, we are witnessing a watershed in Europe's fiscal history.